Hey everybody, welcome to your weekend review. For the week of Monday, February 20th, 2023, the markets were closed on Monday due to President's Day, though we were not off because we learned as a valuable lesson from a great book, Discipline Equals Freedom from Jocko Willink. Your life is every day. This is not a part-time gig. This isn't a punch your clock and go home for the day type of thing. You don't get weekends off. No, there is no such thing as the weekend. Your life is an everyday gig. Every day is Monday, and you might not like that. Me, I love it. To me, every day is the beginning, a new day, a new week, a new shot at life, an opportunity to come out the gate like a man possessed and attack the day without mercy. Today, we are taking scalps. We're putting pressure on. I'm the aggressor. I'm on the attack, and of course, I will get tired. I will get beat up. I will get knocked down and drained, and there will be some bad days, but I will not stop. Learn that lesson from Jocko. Discipline equals freedom. Go out there and get it. Markets reopened on Tuesday, and the hits just kept on coming. UMBS were down 48 basis points on the open. 10-year Treasury was up 5 basis points. Pretty clear the market has moved to a whole new pricing philosophy. Headed into the 3-day weekend, we knew there was a risk that Friday's rally was driven by position squaring, as in traders basically closing out bonds to cover short positions. Heading into the new week, new short positions are back in fashion. From a data standpoint, a series of stronger Eurozone services PMIs pushed EU yields quickly higher overnight, greatly adding to the selling pressure. MBS blowing right through floors. We've gone through 4 different floors in the last 5 trading days. The market services PMI came in at 50.5 versus a 47.2 forecast. It was 46.8 previously. Investor purchases of U.S. homes fell 45.8% on a month-over-month basis, with the largest declines occurring in the pandemic boom towns such as Vegas and Phoenix. Almost the entire month of February has been a mad dash from the lowest rates in months to the highest rates in months. The whole ordeal can be traced back to several key economic reports, with mid-tier reports occasionally piling on. Today saw a surprisingly large reaction to a mid-tier data, as in the market PMI. The only way to reconcile the disproportionate reaction would be to add some extra overseas selling from the holiday closure and the overnight session, which we also saw strong PMIs in Europe. At the end of the day, we were down 67 basis points on the day. The 5.5 ended up at 99.56, which puts us below all of our technicals for that 5.5, which puts us down into a whole new trading range. We might have to change coupons if it stays down there and we don't get any kind of rebound tomorrow. While rent growth has been slowing, it still rose at more than double the pre-pandemic rate. Rental price gains began to increase near the end of 22 and have risen by about an average of $300 in the past 2 years. Annual single-family rent growth is projected to slow throughout 2023, but it will likely not decline by enough to wipe out the gains from the past 2 years. Big emphasis here is rent growth is slowing, rents aren't going down. Existing home sales fell 0.7% month over month to a seasonally adjusted annual pace of 4 million units. This is down 37% versus a year ago. The median home price came in at $359,000, which is an increase of 1.3% compared to a year ago. Prices rose everywhere except the West. Inventory increased slightly from 970,000 units to 980,000 units, down 15.3% from last year. This is about 2.9 months supply, but only 626,000 of those are available for sale and not under contract. Last month, first-time home buyers were 31% of sales and cash buyers were 29%.